If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
What's going on, everyone? I'm Shawn Winslow, and this is the Multifamily Money Podcast. Welcome back to another Finance Friday episode. This is where we dive into tips, strategies on how to get your money working for you harder and smarter, because we all know it's not about what you make, but what you keep, so you can create the lifestyle that you want to live and chase those passions that mean the world to you. All right, before we get into today's episode, just a little housekeeping as always. I just want to thank everyone that's been leaving ratings and reviews. As you know, the listeners know, and for those that are new that don't know, I'm on a mission to get to 100 ratings and reviews on Apple Podcasts. And originally it was a year goal, but listeners are so awesome that took off so fast that I needed to kind of recalibrate that goal, at least in terms of when I wanted to reach it by. So instead of saying this year, I said the first 6 months. So by the end of June, I want to get to 100, and we're already at 86, which is awesome. So only about two and a half months to go until we hit that. So thank you for those that have taken the time to leave a rating and review on Apple Podcasts. And for those that haven't, I would greatly appreciate it if you find any value here if you could just take some time to leave, a nice rating and review. And as well as if you do find value, if this brought you any type of value or any type of positivity in your life, please share this with a friend, maybe two. All right. Well, thank you as always. And let's get into the topic on hand. So as you know by the title, we're talking about multiple income streams. As most people know, we're conditioned, do well in school, get a good job, and then stay at that job for 30, 40 years, build up a retirement account, and then live off that retirement account. And the reason I'm talking about this, so I was reading an article the other day talking about the 4% rule. And for those of you that aren't familiar with the 4% rule, it's simply a rule for retirement that you should only take 4% per year of your retirement account and live off that for the duration of your retirement. And this was created by an individual, Mr. Ben Benjamin, in 1994. He came up with the 4% rule. So for instance, let's say you want to live off $100,000 a year in your retirement. Well, based on this rule, 4%, you would need $2.5 million. Now, if you only needed to live off, say, $50,000 a year, that would drop down to $1.25 million. And that's what you would need in your account based on, inflation and, that you would have this account consistently invested. So, as you withdraw, you'd still be making some money. So, you'd still be getting a return. So it should last you the duration of your retirement. And the reason why I bringing this up, and the reason why there's an article, is because Mr. Benjamin came out and was saying that there should be, tweaks made when you're in a climate like we're in today, where we're seeing, really high, really strong inflation, over 8%. And I'm just going to read what he said here in the article. He said the long-standing method calls for spending 4% in the first year of retirement and then adjusting that amount annually to keep pace with inflation. Such an approach would have protected retirees from running out of money in every 30-year period since 1926, even when economic conditions were at their worst, Mr. Benjamin said. He also said the problem is that there's no precedent for today's conditions. His concern echoes a recent report from Morningstar Inc., which recommends a 3.3% initial withdrawal rate for those retiring today who want the spending to keep pace with inflation over 3 decades and a high degree of certainty their money will last. So in the current conditions we're in the market, they say you should be reducing it to 3.3. Now, Mr. Benjamin, his latest revision, it doesn't necessarily mean going below the 4%. He said that the 4% rule hasn't really been 4% rule for some time. His original research was based on a portfolio with 55% U.S. large cap stocks and 45% in intermediate term treasury bonds. Since 2006, he has revised that portfolio to add international stocks and mid-sized small cap and microcap US stocks, as well as treasury bills. That raised returns and supported a safe withdrawal rate, which he increased to 4.7%. However, he will go to say that there are challenges making forecasts right now, and he suggests cutting spending if possible. New retirees with highly diversified portfolios that would normally support a 4.7% withdrawal rate might want to start around 4.4%, he said. And he retired in 2013, and he plans to do just that. He says, I won't eat in restaurants as much. I live a fairly simple life. I don't make a lot of trips, and I'm happy with a deck of cards and 3 other bridge players. Now, that's great for him, right? If he wants to live that style of life and that makes him happy, that's amazing. More power to him and more power to people that want to live that life. But I know that's not everybody. And the reason why I know that is because that's not me. And I know people that also know that's not them. And there are times in life when you need, to cut back, dig in those heels, and work hard so that you can have a brighter future. But we're talking about the future right now, right? We're talking about retirement. That is the future. Whether your retirement looks like not working at all or just a different sense of working, right? But that is the future. I always say, do stuff now that most people won't, so you can do stuff in the future that most people can't. Well, what's the point of doing that if you got to scale back, not go out to restaurants as much, not travel, and just stay in and play bridge with 3 people? Hey, don't get me wrong. I love playing board games, different kind of games with people, but not every single day, not my only way of entertainment, right? So to me, I don't agree with that. And I don't think you should have to do that. But how, Shawn? You need to do that in these markets, right? To be able to not run out of money. But if that's your only means of retirement, then yeah, I do agree with everything he's saying. But it's just so sad that everyone's conditioned to think that that's the only way to develop a retirement. Invest money in a 401k and an IRA. And when you retire, only take out 3 to 4%. What happens if you retire in a down market? The portfolio loses 10, 20, God forbid, 30%. What are you going to do now? If you lose 30% of 2 million, that's 600,000. Your withdrawal rate is going to look a lot different. At 2.5 million, if you lose 30%, you're no longer going to have even if you continue to use a 4%, you're no longer going to have that $100,000. And why have to stress about that and have to move this gauge around and continually stress, am I going to run out of money? And like here, he goes on to continue, talking about the stock market, because he added those mid cap and small cap and micro caps, which for those of you that aren't familiar, it's based on the size of a company. So you have the large cap stocks, think like your Apples, your Teslas, it's based on capitalization rate, market cap, right? So those are the large caps. Then you have some mid caps, companies that are smaller than that. And then you have, small caps that are generally, less than 100 million, mid caps, 100 to, I don't know if I can't remember the actual tiers, but it's either 100 to like 500, 100 billion. It's somewhere around there. And it might even be less. I could be way off, but the micro caps are even smaller. Those are like, it's either less than 50 or even less than 20 million. So there's risk there, right? Because the smaller the company, less scale, more risk, not as established, most likely. It could be, don't get me wrong. But if, you're trading on the stock exchange in that size, most likely not, right? So there's usually more risk there. So he's putting more risk into his portfolio to get that 4.7. Now, don't get me wrong. I'm not a risk adverse person, but when you're in retirement and this is your only source of income, you got to look at it. And so anyways, he goes on to say that stock valuations are high, right? They're currently trading at roughly 36 times corporate earnings over the past decade. And this is according to something, the CAPE rule, Robert Shiller's CAPE rule, and that's cyclically adjusted price to earnings ratio. And that is double the historical average. And while interest rates, and he goes on to continue, while low interest rates justify higher stock valuations, to some extent, I think the market is expensive. So he's already telling you it's expensive, right? But he's already allocated a riskier portion of stocks to his portfolio. And yes, he has added, some treasury bills. But as we talked about in the last episode, the bond market is an interesting place right now. It's not a great, there's a lot of, headwinds and turmoil and uncertainty there. He even says it himself, like, aside from cutting spending, retirees can protect their nest egg by reducing their exposure to stocks and bonds, he said. So both. So that's his entire portfolio. So where's he putting it? While Mr. Benjamin said he would normally invest about 55% of his savings in stocks and 45% in bonds, his concerns about both markets have left him with closer to 20% in stocks and 10% in bonds, with the rest in cash. So the rest is in cash when you're at, per CPI, 8.5% inflation, but we know it's way higher than that. So you're leaving it in cash. And we all know what people say, cash is trash. Well, it is if you're not actually putting it to work. No, I get it. If he's just holding some dry powder because he thinks there's going to be a correction and he wants to put it to work, I get it, right? But why not take some of that and create an ultimate stream of income, right? It's the whole point of, he even admits it, he's uncomfortable holding that much in cash. But with the Federal Reserve announcing an intention to aggressively raise interest rates, it's not a great time to invest in financial assets. He said he plans to buy stocks if the market drops significantly and stocks become cheap. So yeah, he's holding some, dry powder there. But why not diversify? Why are most people so reliant on this one source of retirement funds in the stock and bond market, which is even crazier place to be now? I've gone over this before with, all the algorithms, that type of trading, you just don't really handle a chance. And it leads to more, in my view, trading that's not based on fundamentals. And that's not a great place to be if that's where your entire retirement funds are in. So the point of this episode, which led me to think of this, is you need multiple streams of income. And I would never come on and say you shouldn't have anything in the market. That's not me. I know there's some real estate investors that they beat that drum constantly. I believe in diversification, but to me, that's not a diversified portfolio. 55% in stocks and 45% in bonds. That's not diversification. You need some alternative investments. And for me, obviously that's real estate, but when it comes to creating multiple streams of income, there's multiple ways to do that. Yeah, for me, it's real estate. For people, that could be long-term rentals, short-term rentals, could be storage, could be industrial, triple net. There's many ways to do that, right? But it also could be, investing in, businesses. Maybe someone who's created a business that needs some, capital. It's a solid business. It could be investing in an e-commerce business where you get some passive income. And that will lessen the blow. Say when you want to retire and the market drops, if your entire portfolio is not in stock and bond market, and you have these other sources of income coming in, you're not so reliant on oh my God, do I need to adjust my 4%, withdrawal rate? Am I going to run out of money? Especially when it comes to real estate. If you buy right and manage right, you're going to know what your return is. You're going to know that on average, it keeps up with inflation. So you're going to know you're going to be safe from that aspect. And then you also know that historically, home prices, real estate prices have increased over time. So people become extremely wealthy when it comes to real estate because they buy and hold. So one, you have the cash flow to weather the storms, and then you have the appreciation at the end if you ever have to take anything out to fund any unseen scenario or if you just want to do something that you're passionate about, right? So to me, that's why real estate is the way to do it. But that's not why I'm on here. I'm on here to talk about creating multiple streams of income. And I know there's always questions of like, well, when should I do this? Obviously, what should I do it in? But the biggest question is like, when? When should I focus that energy? And to me, it depends obviously what one you want in life, but also, do you want to take a more active or passive role in this other stream of income? So you have your day job or you own a business, but you want to create some other income. Do you want this to be an active role or passive? Now, if you want this to be an active role, if you actually want to be out there, grinding, creating this income, you want to be the creator of it, to me, that's not something to focus on right out of the gate. You want to establish yourself in whatever career or business is your main business. You want to create that base until you're really good at it. This is your niche. People know you for this, and you've created this base that can already support you and support what you're trying to do. There's no timeline to give you for that. Some people that could be really quick. Some people that could be 5 years. I would say most people it's going to be 10 plus, whether that's creating a business or establishing yourself in the corporate world and building a career. And then once you do that, then that's when you can allocate, your 20, 30, 40% of your time to building that, quote unquote side hustle, that alternative stream of income. Because you've already become an expert in your base career business, and you've created it so it can kind of run, either on its own, or you can not allocate as much time because you're already established there and you're just so proficient at it. And then you can allocate time to the next thing. See, the mistake I see is people want to create that so fast. They want to create that other income stream so fast that they try to do it right away, that it hurts their main thing. And if their main thing suffers, it's going to end up suffering. It's going to end up transferring over to that new income stream, that new side hustle, and that's going to suffer. So make sure that base is already solid. Now, if you want to do this passively, that's a completely different story. You can start doing that immediately. As long as you have, the disposable income to do that, you can give that money to other experts that are experts in other fields, and then they can create you income. Now, on average, are you going to make less than if you did it yourself? Yeah, probably. I wouldn't say by much, but time. What is time worth to you? You're not going to be giving any more time, but you're going to be getting another income stream based off someone that built their base like you're currently doing. They become an expert in that field, and you're entrusting them to create that other income stream for you. So it all depends. You want to be active or passive? If you want to be active, build your base first. Become that expert in whatever that industry is, and then start building other income streams. Now, if you want to do it passively, as long as you have the disposable income, you can start doing it immediately. And then maybe you take a hybrid role. You start doing it passively, right? While you're building your base. So you're already starting to get other income streams trickling in. And then once you've built that base, then you go off and do something actively and then create even more income streams. That's what I would do. That's what I've done. And that's what I recommend. So I just wanted to get on here and share that with you all, because after reading that article, it just saddens me that so many people think that's the only way to save for retirement and live in retirement, because it's not. Quite frankly, I think it's a terrible way to do it. Not only is your quality of living not necessarily going to be as exceptional as you might want, but there's going to be that stress added of like, am I going to run out? I don't want to live that way in retirement. I don't even know if I'll ever really retire, but at that stage in life, I'll just say, I don't want to live that way. Why would I want to live that way? You work hard, create great things for yourself and your family, and then you got to live with that stress. Am I going to run out? No, thanks. Not for me. So I just wanted to share my thoughts on multiple income streams. It's something that I think everyone should have, because life is cyclical, economy is cyclical. Some things are up, and then those things are sometimes down, and then there's other things that are up when others are down, right? And you want to be able to be diversified, to always be in that happy medium of like, yeah, some things I have right now are not performing, but others are outperforming. And so if you're just relying on one income from one job, and then in retirement solely from a 401k retirement plan, that's not good, because when that's hurting, then you have nothing else to support you. So to me, that's a major part of financial freedom and financial health in general. So if you haven't created another source of income, I highly recommend you going about and doing that. And a great way to start is like, what are things you believe in? Like, I know I always think, what are you passionate? But that doesn't always work, right? Now you can go down the passion route later on once you've established yourself. But like, what are things that you fundamentally believe in that you think, one, are good for the economy and that will work in the economy? And then go after that and see where you can make an alternative stream of income. So for me, it was housing, something we're always going to need. There's a lack of affordable housing right now. For a while, there's a lack of people really taking care of housing, investing back into it. You know, as I always say, we're 4 million units of housing, deficit of 4 million units. So to me, that's something I knew that the economy needed and that would work. And then you also know all the benefits of real estate that I always talk about. So that's why I chose that. But there might be other alternative sources of income that work for you as well. So if you haven't done so, I highly recommend creating another source of income. I know you'll thank me in the future, because I've already thanked those that gave me the advice many years ago. All right, everyone. Thanks for tuning in as always. Get out there, crush it, so you can live the life you want and create a great life for those others around you. We all need that right now. All right, everybody. Take care.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.